Imagine spending years building your savings, saying no to things you wanted, driving the same dependable car, watching the number slowly climb until one day you finally reach $20,000. Let's imagine someone named Ethan. The moment he saw that number in his account, he expected to feel relieved. Instead, his mind immediately jumped somewhere else. Maybe it was finally time for a newer car, a bigger apartment, a vacation he'd been putting off. After all, he'd earned it. And that's exactly why this moment is so important. Most people think the hardest part is saving the first $20,000. In reality, the hardest part begins after you've saved it. Because once you have meaningful money, your brain starts looking for meaningful ways to spend it. If you've reached a savings milestone, or you're trying to get there without undoing years of progress, consider subscribing. On this channel, we explore the psychology behind money and the decisions that quietly build long-term wealth. Now here's what Ethan didn't realize. There are usually only two paths after your first $20,000. One turns that money into the foundation of future wealth. The other slowly turns it into lifestyle upgrades that feel completely reasonable in the moment. Neither path starts with a dramatic mistake. It starts with small decisions. A monthly payment here, a purchase there, a reward that seems harmless because you've worked so hard to get here. The problem isn't buying something nice. The problem is spending money before you've built a system that protects it. And before Ethan invested a single dollar, he discovered there were two steps almost everyone wants to skip. Ironically, those two steps often determine whether the next 20 years become financially easier or much harder. Ethan assumed the next step was obvious: invest the money. But before he bought a single investment, he looked at something else first. Debt. Not all debt is equal. A low-interest mortgage is very different from a credit card charging 20% or more. If Ethan invested $10,000 hoping to earn around 10% a year, while another $10,000 sat on a credit card at 20% interest, the math simply didn't work in his favor. One return was uncertain, the other was guaranteed. Every month that debt stayed unpaid, it quietly worked against him. So instead of trying to grow his money immediately, he focused on stopping the losses first. Once the expense of debt was gone, Ethan felt like he could finally move forward. But there was one more step: an emergency fund. At first, it felt like a waste. Why leave thousands of dollars in a savings account instead of investing it? Then Ethan realized an emergency fund wasn't supposed to make him richer. It was supposed to keep him from getting poorer. Imagine losing your job, or your car suddenly needing a major repair. Without cash available, you're forced into bad choices. You might sell investments at the wrong time, or rely on expensive debt all over again. A few months of essential expenses sitting in a high-yield savings account changes that completely. It gives you time to think instead of forcing you to panic. Only after Ethan had paid off his high-interest debt and built that safety net did he begin investing, because he understood something most people only learn after making expensive mistakes. A strong portfolio is important, but a strong foundation is what allows that portfolio to keep growing, even when life doesn't go according to plan. And with that foundation finally in place, Ethan could focus on the part everyone gets excited about, actually putting his money to work. With the foundation in place, Ethan was finally ready to invest. Like most people, he immediately wondered which investment would make him the most money. The internet had thousands of answers. Buy this stock. Wait for the next crash. Invest in the newest trend. For a while, Ethan thought successful investing meant constantly making the right prediction. Then he discovered something much simpler. Most long-term investors don't beat the market. They buy the market. Instead of trying to guess which company would become the next big winner, Ethan invested in broad, low-cost index funds. That meant owning hundreds of companies with one investment instead of relying on just a few. He also made use of tax-advantaged retirement accounts whenever possible. A Roth IRA, for example, allows qualified investment gains to be withdrawn tax-free in retirement under current U.S. rules, making it one of the most valuable accounts many investors have access to. Then Ethan automated everything. Every month, money was invested without him having to think about it. Because consistency matters far more than finding the perfect investment. Imagine investing $20,000 today. Given an average annual return of around 10%, it could grow to roughly $350,000 over 30 years. Add regular monthly contributions, and the outcome becomes even more powerful. The biggest advantage isn't earning higher returns, it's giving your money more time to compound. That's why Ethan stopped worrying about the perfect moment to invest. Markets rise, markets fall. Nobody knows exactly what they'll do next month. Waiting for the right time often means missing years of growth. Instead of trying to predict the market, Ethan focused on staying invested. Because over the long run, patience has historically been a much more reliable strategy than trying to outsmart the market. And once his investments were running on autopilot, there was only one challenge left: making sure his lifestyle didn't quietly undo everything he'd built. By this point, Ethan had a plan. The expensive debt was gone, his emergency fund was ready, his investments were growing automatically. Now came the part that quietly ruins everything for many people: lifestyle inflation. After years of saving, it's tempting to think, I deserve an upgrade. Maybe you do. But every new monthly payment competes with your future investments: a more expensive car, a larger apartment. Even small upgrades can quietly reduce the amount you're able to invest every month. Over decades, that difference can become enormous. Ethan also realized that not every dollar belonged in the stock market. Money needed within the next year or two was better kept somewhere stable, like a high-yield savings account or short-term government securities. Long-term money could stay invested. Short-term money needed stability. He also understood that investing looks different at different stages of life. If you're young, time is your biggest advantage. You have decades to recover from market downturns. As retirement gets closer, many investors gradually reduce risk because they have less time to recover from large declines. The strategy changes because your timeline changes. Looking back, Ethan realized the framework had always been surprisingly simple. Pay off expensive debt. Build an emergency fund. Use tax-advantaged accounts when you can. Invest consistently in diversified index funds. Increase your investments as your income grows. And avoid letting lifestyle inflation steal your momentum. None of those ideas are exciting, but that's exactly why they've worked for so many long-term investors. When Ethan first reached $20,000, he thought he'd reached the finish line. He hadn't. He'd simply reached the point where every decision mattered a little more. Because in the end, building wealth isn't about finding the perfect stock. It's about creating a simple plan, sticking to it, and giving time the chance to do what it has always done best: turn patience into wealth.